Welcome to Real Vision. It's Tuesday, December 8th, around 2:30 p.m. Eastern Time. This is the Real Vision Daily Briefing. I'm Ash Bennington, joined shortly by Tony Greer. But first, with the day's stories, Haley Drasnin.
Hi, Ash. The markets were reacting Tuesday to hopeful vaccine and stimulus news, especially with the UK starting to distribute the Pfizer vaccine. We've been talking a lot about the dichotomy between the real economy and the markets, and we're seeing it firsthand this month in December with record highs so far, despite a weak jobs report for the month of November. The U.S. has added back around 56% of the jobs lost from the spring, but 9.8 million jobs still have not been recovered, and the losses at this point are on par with the worst point in the Great Recession. So I wanted to highlight the K-shaped recovery in the housing market because, frankly, I don't think it's being covered enough, and it's so clear. Moody's Analytics found that 12 million Americans are behind on rents and utilities, and they'll owe an average of $5,800 by early January. In total, tenants could owe $70 billion in back rent. It's really an alarming sign that millions of unemployed Americans can't pay for basic needs. The federal eviction moratorium is set to expire at the end of the year on December 31st. This order came from the CDC in September and had provided protections after the CARES Act expired over the summer. Evictions really do underscore the deep need for another stimulus bill. Those who are expected to pay that back rent are also likely receiving unemployment benefits that are also set to expire by the end of the year. The final version of this relief package by bipartisan senators does include an extension on the moratorium of evictions, but landlords are still eager to get paid because they have their own bills and taxes to pay too. So it's really just further kicking this can down the road. Meanwhile, builders of big homes are seeing the best housing market in 30 years. Toll Brothers earnings were released on Monday. Their sales are up 7% from last year. They generated around $2.5 billion in sales, and shares of Toll Brothers are up nearly 25% in 2020. Real estate brokerage firm Redfin, their total revenue is up 7% year to date, and its stock is up more than 400% since its March low. The iShares U.S. Home Construction ETF is up more than 125% since March. The U.S. housing market has gotten a boost from pandemic trends as many have left large cities in search of bigger homes in less crowded areas where they can work remotely and enjoy more space. Because interest rates are low, mortgage rates are historically low, right now below 3%. The question is, it can't last forever, but can it last through 2021? It's a cyclical business. There will be a bust if there's a boom, but it's just a matter of when. All of this data indicates that it won't happen anytime soon. What's driving this boom is really true demand. It's a change in consumer behavior. I came across the S&P CoreLogic Case-Shiller National Home Price Index, which measures average home price in major metropolitan areas, and it rose 7% year over year in September. It's the highest annual growth rate since May 2014. Existing home sales, which make up the bulk of the housing market, also continue to trend upwards and recently marked 5 consecutive months of month-over-month gains. Anyways, this data just goes to show you that the deep reality of the COVID economy is that the K-shaped recovery clearly has two different outcomes facing Americans, and we need to be aware of it on all levels, not just Wall Street and Main Street, but the housing market too. Back to you, Ash.
TG Tuesday. Tony, welcome back.
Great to be here, Ash. Great to be here, man.
Always enjoy these shows. Tony, so what are we looking at? We're doing this on a Tuesday, as always. What happened yesterday? How did we start off the week?
Yeah, it's always a good way to look at it, Ash. We came in, this week to me seems to be about, the Airbnb IPO and the Tesla secondary that's taking up a lot of the oxygen in the markets right now. Some other headlines that have been interesting to me are the Bank of Japan became the biggest stock owner in Japan, which is, sort of a nod to what their policy has done to their financial markets. They've been battling the deflation beast, and they've needed the Bank of Japan to get in there and actually buy ETFs and stocks and commodities and stuff like that to keep their markets alive. So, that is hopefully not a sign of what's coming to our market here, but you have to keep an eye on it because, we're employing a lot of the same tactics that Japan employed for a long time. And, they haven't really been able to inflate their market since. So that's kind of the Debbie Downer story, I guess, that I'm going to start off with, that kind of broke on Monday. And then to get into the market,
in some ways, it seems like Japan has been the ghost of Christmas future, right? It's like all the things that we say aren't going to happen in the U.S. They get previewed in Japan, and then it seems like they get rolled out here with deepening risk.
Definitely, we're running along a dynamic like that, especially until we can spark some kind of actual inflation.
Yeah.
So we get into the market rotation yesterday, and we've got gold stocks up, 3.5% rally as gold bounces off support. We've got technology, going red yesterday, a little bit of weakness in refiners, weakness in cannabis stocks. But in general, as you can see, we come in today and, markets get back on their feet. So it's been a different type of rotation, I would say, since that Miracle Monday, if you remember, when we came in on November 9th. Where we had President-elect Joe Biden and the first of several COVID vaccines. And to me, that's really when the market started taking on a little bit of a different shape.
Yeah. You rolled up some of the interesting data points from November 9th to the current date. What are your thoughts on that and the move that it's made?
Man, that's been everything to me, Ash. That's been, the signal to me that the rotation is changing. But as you can see by the S&P currently scraping the highs of all time on the screen behind me up above 3,700, that this rotation is capable of advancing the stock market and continuing the ascent, I'm calling it, toward S&P 4K, if I may. It's been a dramatic change in index market cap rotation. So we've had the Russell pick up the lead, and the Russell is up 16% since Miracle Monday, with the Nasdaq and S&P only up 5.5%. FANG stocks, believe it or not, are down a couple percent since then. So to me, that is a dramatically different dynamic, and it's interesting to see that we still got the S&P at the highs here.
Yeah, right now as we're filming, it's about almost coming up on 3:00 Eastern time, and we got the S&P at looks like 3703.
Yeah, exactly. So the S&P can continue to forge higher. That internal move has been led by a lot of natural resources, Ash, right? Which is very different from the lockdown rally, which was led by big tech. So we've got XLE up almost 40% now since Miracle Cure Monday. ExxonMobil today blasting through its 200-day moving average. I'm assuming that we're going to pick up some tailwinds from that. The second best performer that I'm watching has been Jets, right? The airline sector. The ETF is Jets, JETS. Sector's up 32%. We got a comment last week out of the Delta Airlines CEO that the market perceived as they would be burning less cash than they had been. Airlines got a big lift in their sales from that. And, this rally just seems to be able to sustain itself on the market's ability to be able to look past into a vaccinated world or a reopened world. And what's interesting is that you've got other sectors like today, you've got XME, industrial metals and mining, straight up a rope, right? There's been an industrial metals melt up. Banks are starting to participate. Aerospace and defense are starting to participate. So that's really the key to me, Ash, that we've got a different rotation, but that the market is still sustaining with FANG stocks really not in the lead. And I think that's something that the market probably didn't expect to happen.
Yeah. To continue on with Monday, one of the stories that I know that you were watching is the story that Goldman Sachs is considering moving its asset management arm from New York City down to Florida.
Yeah, I guess that's a feather in Mayor de Blasio's cap. And, I got a feeling that that's what he might be here for. And, when that is Goldman Sachs responding to a change in their surroundings, I would think, and you can go over it a million different ways. And I don't want a New York bash, but I tell you what's gone on there in the last 9 months to a year has caused an exodus of, city dwellers to move out to the suburbs and get away from living in what they're now perceiving as a probably less safe city life. And, the corporate America is obviously going to follow because they don't want to be sending their employees into a, God forbid, higher risk, more dangerous daily atmosphere. that may not be what they're accustomed to, and certainly something that they may not go back to after this lockdown. So
Yeah.
maybe they're pivoting, to just a different atmosphere. Maybe they're pivoting directly to a red state. I don't know. But, that certainly is something that we've got to keep an eye on, because they are leaders of the industry, and where they go, a lot of people follow. And you can imagine that probably 5 or 6 other big shots at other firms said, you know what, the coast may be clear to head down to Florida.
Yeah.
Why not? So if we're going to be facing higher taxes and a different situation here in New York, I would be disappointed, but not shocked to see more of this.
Tony, let me throw this out there. That's the political calculus and the tactical consideration. What about this question? If we're in a different kind of strategic environment, one of the things that this terrible COVID crisis has done is it's basically virtualized the world, right? It's virtualized the way we think about work. And so the question is, states that have higher tax regimes, higher, especially income tax regimes, are they going to be as competitive against the Floridas, Texases, Wyomings of the world? And when you can live anywhere and do your job from anywhere, how does that change the calculus about the way people think about where they want to live?
Well, I think you spiked the football nicely right there, Ash. It changes the calculus of everything, and this was, that headline, you can let it go by casually, or you can let that headline smack you in the head and wake you up a little bit, like you said, because, this changing calculus is going to change a lot about city life, and it's going to change a lot about markets, and it's going to change, a lot about what traditionally has gone on in the financial industry, having been based in, New York City center, largely around, Goldman Sachs and their operations here. They always ran a pretty high profile New York operation. And so this is something to consider. And you hit the nail on the head. People should be, doing the calculus now as to what this is going to mean. I certainly don't have all the answers. I still think it contributes to an expansion in the building sector in a couple of different ways, if I may. We just got interesting news out of Toll Brothers, and this isn't Goldman Sachs related, but related to moving out of the cities into suburbs, whether it's for city dwellers and individuals or for corporations. This to me is the home builder trade. Right. This to me, is rhymes with Toll Brothers coming out and saying that they've got a record for high priced homes. And now they've got some pricing power with a lot of competitive buying going on in their areas. So, that's just a way that the American landscape is changing a little bit. And so the Goldman Sachs headline, I think, plays into that, Ash, and we should all be just on our toes to know what it means. That's all.
Yeah, you think about it, these kids, young men, young women coming out of schools, business schools, they come here to New York City, and the calculus has been that they pay $3,000 for a studio apartment, and that suddenly that low 6-figure salary that everyone back home thought sounded so great doesn't look so good when you're spending $36,000 a year on a 500 square foot apartment.
That's so well put, Ash, and it brings me back to my days of coming out of college, and the race in the late 80s was to get one of those investment banking associate jobs where you come out of school and you're an investment banker or in one of the sales and trading programs. And that was enough to get you by back then, because you were making, that early 6-figure salary at a young age, and you were able to afford that rent. And now that salary is probably a lot lower and that rent's probably a lot higher. And, you've got people doing all kinds of life calculations. And it's all going to change. I feel like that's what the technology market shouted at us for the last 7 months off of the March lockdown lows, was that everything is going to change. It's going to be more technology centric. It's going to be more cybersecurity concerned. It's going to be more cloud storage driven. It's going to be more of everything tech. So, this is part of the calculus. It factors out. I like that you use that term, because it factors into the markets just like it factors into the headlines. And it's very important to follow along with both.
Yeah. I got a buddy, finance guy, who's convinced that he's going to be moving to Chiang Mai, Thailand.
I'm not ruling out anything at this point, Ash. You know what I mean? People are going to be able to go where they want to go and hopefully still work for whom they want to work for. And I can't think of that. That's just a great, credit to our ingenuity if we're able to break up this whole, the whole cultural idea of commuting an hour and a half to a big city for work. I think that might be one of the positives that we can squeak out of the COVID disaster.
Tony, that time I spent all those years on New Jersey Transit, I'm never getting it back.
Yeah, that is for damn sure. I mean, I know my life changed for the better when I stopped commuting to New York City, because I got a lot of ideas for those 3.5 hours a day. I really do.
Yeah, absolutely. Talking of which, talking about locations and residences, what are your thoughts on Airbnb?
Man, it fits with the market scenario right now, where we're seeing little bits of M&A. We're seeing, we're seeing the Airbnb deal come out. We're going to do the Tesla raise. Airbnb is going to be something to me. The decision is it going to be something that the big plain vanillas are eventually going to come after or not? Is it going to be like a Spotify, where it's going to be one of those tech stocks that you're going to have to be long, or is it going to be, something that, maybe, is it something like a WeWork type of scenario where it's, seen its best days before it gets to the IPO? Now, I haven't been following Airbnb's story that closely, or, the pricing or anything like that. My preference is to sort of have an angle on whether or not I like the company. I've used Airbnb, so I can say that I do. And I think that it's got a future in the future of the U.S. financial economy. It's obviously going to change a lot from staying in big name hotels everywhere you go. So the Airbnb is just a market, another factor that contributes to the bull market that we're seeing, right? It's allowing them to access capital in the markets. That's what they're there for. And, I'm going to reserve judgment on the IPO picking a direction, because I'm not smart enough to do that. We're going to see how it contributes to the new tech IPO landscape and see how it contributes to the whole story. My guess is right now, with lots of capital looking for a safe place to go, or at least a place with good return to go, I would imagine that Airbnb is going to be welcomed with pretty open arms, given the market scenario that we're seeing right now, especially with the NASDAQ picking up a little bit of life in the last couple of weeks versus since Miracle Monday, which was 4 weeks ago now. So a little bit of a slight nuance in the rotation change. I think the Airbnb story is going to be just, another, look at that. We saw more M&A on the way up. Ash, typical, fits the narrative.
Yeah, it does. And it fits the historical pattern as well. Let me ask you this. You've been talking about the numbers since Miracle Monday, obviously very impressive data. If we rewind the clock back a little bit further and we go back to February 17, I think, on or about, which is when the sell-off began to happen, we're above those numbers right now as well on the S&P. Obviously, less impressively than if you look at it from the turnaround day of Miracle Monday. But how about this, Tony? Let me just pick up on some of the points that Haley Drasnin made in the intro. So the U.S. has added back about 56% of the jobs that they've lost since the spring, but there are still 9.8 million jobs that haven't recovered. And the losses at this point right now, here in December, post Miracle Monday, are at the same point that they were, on par with the worst point in the Great Recession.
Ooh. Well, that speaks to one and the same trade to me, Ash, and that is the trade where the Federal Reserve is inflating assets. And if you have assets, you're going to be okay, right? If you listen to BlackRock this week, I thought that was really interesting, right? The world's biggest asset manager raised their equity outlook to overweight from neutral. Let me read you a quote by BlackRock's Mike Pyle. The big change around the outlook itself is upgrading risk assets overall and seeing as 2021 as a very constructive year for risk assets, right? These guys are on the same plan. They're getting the same read from the Federal Reserve as we are. The Fed is inflating assets. You've got to own them or you're going to have a problem and get left out of this recovery. So I hate to frame it like that, but that's the harsh reality of it. And if what is more unemployment, more economic weakness, more joblessness, what is Disney laying off another 30,000 workers? What is all of that eventually going to add up to, Ash? It's going to add up to a bigger response from the Federal Reserve. It's probably going to add up to a bigger balance sheet. It probably contributes more to the natural resources trade. It probably blasts Bitcoin through the roof. I mean, some of these returns, Ash, since Miracle Monday, oil up 22%, Bitcoin up 21%, testing 20K again. gasoline up 16%, copper up 12%. I mean, this is a serious natural resource move in response to the Federal Reserve's actions. And so since these are the glaring sirens that are sounding in the markets to me, I'm trying to base my, investments in the natural resources sector silo, call it.
Yeah.
So it feels like we're going to see more of the same for that.
Yeah. To that point, you had some interesting bullet points in your note to me today, where you were talking about the oil numbers in China. I thought it was fascinating.
Yeah, it's just important to know, every time oil goes on a run, it's largely because China and India are inhaling it at a ferocious pace. And we learned this week from China's import-export numbers that they just had the biggest, another consecutive record month, but they are importing up 10% basically every year for the last 5 or 6. Right. So they're setting a new record and increasing their intake by 10% every year. That is part of the driver of why we're out of the 30s, out of the 40s into the 50s now in oil. So
and that's compound. If you think about that, that's compounding growth, right? So it's up 10% on a larger base every time. That's pretty substantial.
Yeah, I mean, it's almost like they're up to something. They're still growing their economy. They're still growing out into the suburbs there. And it's a trade that you have to watch. When we had that commodity super cycle, you can call it, from, say, 2000, when the dot-com bubble burst, through 2010, that was a lot of Chinese buying, right? That was a lot of inhaling commodities. That was a lot of commodities that went into building roads and bridges and tanks and firearms and all kinds of things in China. So, it's very important to keep an eye on, the level of consumption by China as a country. So that's important. The gold trade is interesting to me as well right now.
Yeah.
Gold was getting beaten up a couple of days as a risk asset after that miracle Monday when tech stopped rallying and the natural resources sector took off. So there were 11 consecutive days of withdrawals from the total ETF, the gold's ETF total holdings. And so what I think happened is we had the last guys that bought gold above 2000 had to turn around and sell it because it wasn't performing. And now gold is going to go back to being an inflation hedge. She got a perfect bounce off of the 200-day moving average. That lined up with a 50% pullback of the lockdown rally, which went from 1450 to 2075. And now we're looking forward to Christine Lagarde on Thursday of this week, and hopefully coming out with something that's probably incrementally bullish for gold if she has any kind of an upside stimulus surprise. So, Ash, we keep looking around, poking casually around the natural resources sector, but it's starting to be the sector that's putting up those, big game hunter type of percentage weeks and months. So now is the time that we really got to stay focused and make sure that we've got our eggs in the right basket. Yeah.
Talking about resources and metal, you also have a thesis on base metal.
Yeah. Well, I've been calling it, jokingly, the flash renaissance of base metals, right? Because they're up, dramatically in such a short period of time. U.S. Steel has just joined the ranks of the industrial metals and mines that's rallying. First we had the gold miners rallying, then we had, Freeport-McMoRan and Alcoa, a lot of the aluminum producers rallying. Now all of a sudden we've got steel companies joining the rally. So we've got XME flying up a rope, and that industrial metals ETF outperforming almost everything else in the market since Miracle Monday. So, that U.S. Steel story is about U.S. Steel buying the remaining 50.1% stake in Big River for cash, which was why the stock went flying. They didn't have to finance it at all. And, now that we've got the steel stocks starting to percolate in the industrial mining rally, that is something that you definitely do not want to stand in front of, as we both have a monetization situation and a recovery situation going on at the same time.
Yeah. I'm curious what your thoughts are about the big picture framework and the way that U.S. equity markets are discounting news flow. Obviously, equity markets are almost by definition looking ahead at the price of future cash flows. Another point that I thought that struck me from Haley's intro today was that Moody's Analytics has a report out that 12 million Americans are behind on rent and utilities payments. There are people out there who are really suffering. Markets are rising. What is it that markets are seeing? What's the time frame that they're looking at? And how do you think about that discounting function in the way that you look at price action?
Man, Ash, that brings me right back to the thesis of, our bullish equity thesis, which is that the Federal Reserve is inflating assets, right? They are going to have to. They're the one trick pony that only knows how to expand their balance sheet. And it kind of brings me back to Grant Williams' interview with Felix Zulauf a little bit, where, we had to open our minds to the idea of a 40 or $50 trillion Federal Reserve balance sheet. And, that's the thought that I think the market is picking up on. It's picking up on a little bit of that, where the Federal Reserve is only going to address economic weakness with the same type of structure that they've been addressing it. Right? Emergency funding, stimulus checks at home, right? We just got Janet Yellen at the Treasury to signal that we've got a double-barreled dove, in charge of handing out funds to the recovery. And I think that, that's the inflationary story that's taken over since Miracle Monday over the lockdown story. And so when you start to picture, okay, if we're going to have more economic weakness in reality, but we may have some economic data beating on the screen, beating estimates that the market will take and run with. We've got we're throwing kerosene on the fire here a little bit in terms of how this equity market has gone essentially straight up since we came out with a vaccine and the market started looking past lockdowns. So, we're in a situation that the market's never seen before, and we are trying to price in what it's going to be like when Paul Tudor Jones said that, his kids are being held back, with a bridle from going out and, partying and seeing the world and doing things. This is what the market is telling us right now. It's seeing a little bit of that. And it's knowing that the Federal Reserve has also got this sentiment, this easing and dovish position on the markets where they can always add assets to the balance sheet. They can always send stimulus checks to try to help those employment issues and those, debt paying shortcomings that I think we'll probably continue to see. But it gets complicated because we've never seen anything before. And the market keeps sending me the same story by making a new high, that if you don't have assets, you're going to be left out of this recovery.
Yeah. Boy, you bring up the great Grant Williams interview with Felix Zulauf. At the time, I didn't remember the number. I just remembered it seemed outlandishly high at the time. But look, we've gone from the balance sheet beginning to contract. I think we got down to about 3.8, 3.9 trillion, and basically now up over 7.2 trillion on the consolidated balance sheet.
Yeah,
40 or 50, not looking so far fetched, is it?
Well, when you think the rate of change, when you consider the rate of change, Ash, we went from 4 to 7 in one fell swoop, right? That was essentially, call it doubling the balance sheet, if you don't mind. And then, once you do something like that, now you start talking about, it can go anywhere. And this is what they're going to do. And, 4 to 7 sounded like a big deal. 7 to 14, nobody's going to flinch. Right. So they just literally opened everybody's mind to this is what we do. And these are the, daisy cutters that the Federal Reserve comes along with. But as we know, it's having, potentially disastrous effects on society. As you just pointed out, it's not giving people more jobs. It is not allowing them to pay their mortgage or to pay the rent on their business and, go ahead and open up. So we're going to have a lot of fallout that we haven't seen before that we're going to have to deal with. We're going to have some economic growth on top of, this, because of the Federal Reserve's actions. A lot of the economic data like PMI and industrial production is going to pop right back into shape while we have more people that are unemployed and struggling to pay their rent. So, the market's kind of trying to jive out how it's going to be acting in this situation. And I think it's looking directly at Janet Yellen and Jerome Powell saying, what are you guys going to do next?
Yeah, and to get back to that point, I'm certainly not predicting a particular position for the balance sheet. But when you think about the direction and, as you say, the rate of change, it just starts to look less far-fetched. There's a feeling that, what's to prevent that from happening? Are there any structural barriers that prevent it from happening? Are there any guardrails in place? And it seems as though the answer is potentially no.
The answer is no until all of those that are out of work start marching on Washington and making enough noise for people to hear them. And I don't want to go into that scenario, but I fear that our society has been a little bit mesmerized by a lot of things tech. And if, as long as technology can keep your nose buried in your iPhone, maybe a lot of people don't realize what's going on, and you hate to think that that's the deal. But just like we were discussing before the show, Ash, right? That was kind of interesting. There's no college course that teaches you the basics of finance or the basics of markets. Maybe an idea for Ralph. But, these are the kind of things where you talk about people start to go and figure out what's going to happen when they can't pay their rent for a number of months, and they start to say, okay, who do I turn to now? And now everybody is turning toward the stimulus bill, which is still very much a focal point of the markets by the media. I'm not really focused as much on it because I know that it's coming. And I think the market decided that the stimulus is coming no matter what. But in reality, we've got to get the stimulus into the hands of the people that need it, and I think that I fear that that's going to be the big disconnect that we're going to be working with for the next several months. It looks like, the media is reporting, which hasn't been a great job, but the media reporting on the PPP loans shows very much like it went to a lot of places that maybe didn't need it to survive, and it didn't get to a lot of places that likely do need it to survive. I don't want to get on that type of a preacher stool right now, but there are going to be disconnects that continue to occur because of that. And I think that once people wake up to, hey, how come the Federal Reserve is buying this ETF that has Apple bonds in it and the Apple stock is worth gazillion dollars? How come I still can't get the $1,200 to pay my rent? So as that story socializes itself is the only way that we get to a point where there's any pushback against this type of policy.
Yeah. And, at the end of the day, that number, 12 million Americans behind on rent and utilities. I mean, it sounds like a statistic, but the amount of human suffering and pain that represents is extraordinary. And it's greater than 1 in 30 of every American men, women, and children in the United States, right? That's a huge number of people. That's a huge number of households that are impaired by basically an absence of income. Whether it's getting hours cut back, having small businesses not generate the revenue that they did, or getting laid off, not being able to find a job, any combination of those factors, it's just a grim and dismal number.
It is, and I think that we're getting to the point where I'm sure you saw the video of the woman who's a restaurant owner in Los Angeles, and her restaurant shut down. Nobody's allowed to go there, and the governor or the mayor gave, a movie theater the license to set up for a set and record something right across from her restaurant, where they had to set up, a picnic area for the people that are working on the set. And so her video was so heartfelt. And I think, feel like that's the zeitgeist in America right now. I feel like that covers, the heart of America's mood is that, women like her and business owners like her that are being persecuted while, there's another set of rules for a different set of people, whether you're in the government or you're making a movie or something like that. I feel like we're at the point where people see this and they probably aren't going to sit around that much longer. Let's just say that, without collecting a paycheck, without being able to pay rent. I feel like that woman she's truly captured the spirit of the country that's in that predicament really well. And I think that with that getting around, I think people will be motivated to sort of push back against being locked down with no other circumstance to deal with. That's what I think.
Yeah, I mean, I guess the potential good news here, if you want to look for a silver lining, especially a bigger picture silver lining, obviously one of the big news stories today is the United Kingdom beginning to deploy the Pfizer vaccine actually in the field to the broad population. And this has the potential the potential. Obviously, it's tricky to deploy. There are a lot of obstacles to be overcome logistically. But once you get broader vaccine rollout, this is the thing that has the potential to really change the tide.
Yeah, they're going to try to make something like this mandatory. I think the big hurdle that they're going to have to get over is the mathematics that Pfizer's vaccine is 95% effective in preventing COVID, but your immune system is 99.9% effective versus beating it. To me, that's a tough sell for the drug and a mandatory vaccine. But in the UK, while it seems like the media is slamming it on the tape, there are, an equal number of protest videos in the UK that are popping up where they aren't necessarily accepting the vaccine with open arms. So we've got that problem to deal with, right, Ash? Like on top of the logistics of the distribution, you've got to get the buy-in of people saying, yeah, okay, Pfizer, go ahead, clinically untested. And I know that you signed away all the liability and that you have no liability in distributing this vaccine. Hit me in the arm. I don't know how popular that's going to be. I really don't, because it's not something I'm lining up for. I'll tell you that right now.
Well, it's something that remains to be seen in terms of what populations will accept. It's certainly my hope that the safety data comes out and is very clear that it is in fact safe. And if that's the case, we certainly hope that people will get it. But beyond that, thank God I'm not the person who has to make that decision.
There's just not enough time on the tape to know whether or not there are any disastrous side effects. In plain English, that's the only thing that I think is holding people back. Maybe if we had clinical trials and things taking place for months before our eyes, and we could see places where it went wrong and places where it went really right. That's where you get, an educated public. Having people step up to a vaccine with a blindfold on is not going to work.
Remains to be seen what happens there. Tony,
luckily the markets work.
Yeah. Tony, talking of which, as you look out here, obviously only Tuesdays, you look out for the rest of the week. What are you going to be looking for to confirm the hypothesis?
New highs in stocks this week. This was
across broad equity indices. Any places in particular sectors?
I mean, the Russell 2K is roaring to new highs. The Dow is roaring. The Nasdaq's carving new highs. I mean, the worst thing that happened to the bears this week was that, Apple picked up and ran, and Google picked up and ran. And now, even though FANG as a group is really not advancing, you've got different sectors leading the market. You've got a couple of FANG stocks like Apple leading technology, and you've got semiconductors just up a total rope. I mean, this is the kind of thing where they're due to pull back because the runaway rally has been so steep. But now that you've got sectors of technology back in the game, after having consolidated for several months. I mean, if the software sector gets back on its feet again and starts running with the lead like it's had all year, I mean, look out for what could happen in the first quarter of 2021, So this is the kind of time where if you're trying to be cute and short the markets, you're going to have really small windows and really steep markets to have to cover in, because I think that we've got enough momentum now that the writing is on the wall that the S&P is going to wind up at a higher number, and that there are portfolio managers that are not positioned for it just yet.
Yeah, Tony Greer, very well said. I think it's the best place to leave it.
That's fine with me, man. We can leave off there. There's a couple of risks that are worth mentioning, Ash, if I may. And
yeah, please.
And I just want to say, because I don't want to think that, I don't want people to think that, I've got blinders on as a trader and that I'm not seeing the risks, right? I understand that sentiment is getting hot. I understand that the put call ratio is down to low extremes, right? I understand that we could have a snapback rally in the dollar that could deflate commodities for a period of time. But the big picture is, and I think, and I'm keying on this BlackRock statement during a week that I think the S&P is due to carve its way higher. The focus is on upgrading risk assets overall and a constructive year ahead for risk assets. So, that's what's got the animal spirits roaring. And I'm expecting a little bit more of this for the rest of the week, Ash. We'll see next Tuesday if I'm right. Or excuse me, we'll see in 2 weeks if I'm right. But this is what I'm looking for, man.
Crisp and clean, the big picture, Tony Greer.
Thanks, bro.